Okay, so just check the date on your phone. It is Tuesday, February 10th, 2026.
Hmm.
And if you live in, say, the Carolinas, Florida, Ohio, Kentucky, or Indiana, or really, if you just care about how the modern world actually keeps the lights on, today is a pretty massive day.
It really is. This is the day the ledger opens up. Duke Energy just dropped their full year and fourth quarter financial results for 2025.
Right.
And, usually earnings calls can be uh, a bit of a cure for insomnia. This one is different.
It's different because the numbers are just, they're colossal.
Yeah.
We aren't talking about some software startup burning through cash.
No.
We're talking about the actual infrastructure that powers millions of lives. And a capital plan, a spending plan that has hit $103 billion.
That is a number that actually strains the brain a little bit. $103 billion.
Right. So, okay, here's the mission for this deep dive. We're going to skip the boring part where we just read a spreadsheet out loud. I want to understand how a utility company actually makes money in 2026. Because it's a little weird, isn't it? They have to spend billions to make billions?
It is very counterintuitive, yes.
We need to unpack that.
Yeah.
And we also need to figure out where that $103 billion is actually going. Is it wires? Is it power plants? And this is the part I'm really struggling to wrap my head around. What contracted demand from AI actually means for the grid? Because everyone talks about AI, but I don't think people realize how much juice it actually drinks.
Yeah, it's where you get high finance meeting heavy physics and future tech all in one report. We've got the official news release from this morning, the variance reports, and the consolidated financials.
Okay, so let's start with the report card.
Okay.
2025 is in the books. How do they do?
Well, they pretty much hit the bullseye. If you look at the bottom line, their earnings per share, or EPS, came in at $6.31.
Okay, 631. Is that good?
It's exactly what they told investors they would do. It hit what they call the guidance midpoint.
Right on target.
And here's something you don't see very often in corporate accounting. That number, the $6.31, it applies to both their reported GAAP numbers, the really strict government accounting rules, and their adjusted numbers.
Where they usually strip out one-time costs.
Exactly. And those two numbers are usually different. This year, for the full year, they were identical.
Which I guess implies a pretty clean year, financially speaking.
For the full year, yes. And if you compare it to 2024, where they were at $5.71 reported and $5.90 adjusted, this is solid growth. They're doing what they promised, steady, predictable expansion.
But wait a minute, I was looking at the breakdown, and the end of the year looked a little messy. The fourth quarter specifically.
You spotted that, good eye.
Yeah, I mean, the full year was up, but Q4 of 2025 was actually down compared to Q4 of 2024. They came in at, what, $1.50 per share?
$1.50.
The year before, they were at $1.66 adjusted. That's a decent drop at the finish line. What happened there? Did everyone just turn off their Christmas lights?
Not exactly. It was more about the cost of doing business. They faced what we call headwinds.
Yeah.
First, operations and maintenance costs O&M. They were just higher. It cost more to run the machine. Second, interest expenses.
Because debt isn't free.
And utilities carry a mountain of debt to build all that infrastructure. Exactly. So when interest rates are up, that bill gets heavier. But there's another concept here. It's called depreciation on a growing asset base.
Okay, translate that for me.
Well, think of it this way. You build a brand new power plant.
Right.
The day you turn it on, it starts losing value on the books. That's depreciation. And because Duke is building so much new stuff so quickly, that depreciation expense is just climbing faster than it used to. It eats into the quarterly profit.
So it's actually a side effect of their own growth.
Precisely. And then there were some tax quirks, too. Their effective tax rate jumped to over 11% in Q4 compared to roughly 9% the year before. They just had fewer tax benefits to lean on.
I also saw a line item about the Duke Energy Foundation. It looked like they made a pretty big contribution in Q4.
They did, and that, of course, impacts the bottom line. It's charitable giving, which is great for the community, but strictly speaking, it's an expense that lowered the EPS for that quarter.
So, a bit of a mixed bag to end the year, but the yearly target was hit. Okay, I want to pivot to the thing we teased at the start.
The business model.
Yeah, the business model. Because I see this headline. Largest regulated capital plan in the industry. $103 billion over 5 years.
It is the headline for a reason. It's staggering.
But help me understand this. I mean, if I ran a bakery and I told you I was going to spend $103 billion on new ovens, you tell me I was going bankrupt.
Of course.
But in the utility world, spending money seems to be Good.
This is the absolute secret sauce of the utility sector. You have to understand that utilities are essentially regulated monopolies. They don't make their profit on the markup of the electricity
So
itself.
they don't profit from the electron itself.
Generally, no. The cost of fuel like coal, natural gas, uranium, that's usually just a pass-through. You pay what they pay. They make their profit on the infrastructure
The wires and the
and
poles.
the power plants and the transformers, all of it. It's called the rate base.
Okay.
And the government, so state regulators, they allow them to earn a guaranteed percentage of profit called return on equity on every single dollar they invest in approved infrastructure.
Wait. So you're saying the more they spend on building things, the more profit they are actually allowed to make?
In a nutshell, yes. That $103 billion isn't just a cost, it's the seed corn for future profits. By building that rate base, upgrading the grid, building new generation, they are literally increasing the pot of money they can earn a return on.
Wow.
That's why they're projecting an earnings-based growth of 9.6% through 2030.
That completely flips the script for me. They aren't just spending money to keep the lights on. They're spending money to grow their own bank account.
As long as the regulators approve it, yes. It's a mechanism that's designed to encourage companies to build this incredibly reliable, heavy infrastructure that, frankly, no one else would want to pay for.
Okay, so they have $103 billion to spend. What are they actually buying? Is it all just replacing old telephone poles?
It's a mix of, let's say, defense and offense. The release mentions they broke ground on 5 gigawatts of new dispatchable generation resources.
Dispatchable. That's a key word there, right?
Oh, it's crucial. Dispatchable means you can turn it on exactly when you need it.
Right. Not like solar or wind.
Exactly. Solar and wind are great, but they're intermittent. If it's cloudy or it's calm, you get nothing. Dispatchable usually means natural gas, maybe advanced nuclear or large-scale battery storage. They're building the stuff that keeps the grid stable when the weather doesn't cooperate.
And they're serving a massive footprint. I mean, I was looking at the numbers. 8.7 million electric customers.
Yeah.
1.8 million gas customers. That's basically the entire population of some European countries.
It's a huge responsibility, and the usage patterns of those customers are shifting in a big way, which brings us to the topic you really wanted to get into.
The AI factor.
The AI factor.
I have to admit, I feel like I have to be skeptical here. Every company on the planet is putting AI in their earnings report right now just to pump the stock.
True.
Is this real for Duke, or is it just buzzwords?
In the energy sector, it is very real, and it's very physical. We aren't talking about software. We're talking about heat and load. The CEO, Harry Sideris, he used a very specific phrase in the release. He said, contracted demand from AI and advanced manufacturing.
Contracted demand.
That means these aren't just, projections or hopes. These are data center companies, the Amazons, the Microsofts, the Googles of the world signing contracts saying, we need this much power and we are willing to pay for it.
So why do they need so much? I mean, my laptop runs AI, and it doesn't melt the plug on the wall.
It's all about scale. A standard Google search uses a tiny blip of energy. A generative AI query like asking an AI to rate a poem can use 10 to 20 times that amount of energy. Now multiply that by billions of queries. These data centers are essentially massive heaters. They consume electricity to run the chips, and then they consume more electricity to cool the chips down.
So Duke Energy is basically trying to become the gas station for the entire AI revolution.
That is the bet. They are positioning themselves to be the engine room for this tech boom. But, and we should always look at the risks. If you look at the risks section of the report, there's a really fascinating line.
What's that?
They actually list as a risk factor if usage of electricity by data centers is less than currently projected.
Oh, so there's a scenario where they build all this stuff, spend that $103 billion, and the AI bubble just pops.
Or just slows down. Maybe improvements in chip efficiency make data centers less hungry, or the economy cools off and we stop building them.
Right.
Then Duke could be left with what we call stranded costs.
Stranded costs. That sounds expensive.
It means you built a power plant for a customer who never really showed up. And then the big question becomes, who pays for that plant?
Let me guess. Me.
Well, usually the ratepayer ends up holding the bag. So while the growth potential is absolutely huge, the risk is very real.
Okay, let's unpack this by segment, because Duke isn't just one big blob, right? They have different divisions. The electric utilities and infrastructure segment seems to be the golden goose.
Oh, it's the powerhouse, pun intended. For the full year, that segment brought in over $5.3 billion in income.
Wow.
That's up significantly from the adjusted numbers in 2024.
And what drove that? Was it just us using more air conditioning?
Partly. Residential sales were up 3.2%. Commercial was up 1.8%. So yes, homes and businesses did use more power, but look at the industrial line.
It's down 2.0%.
Exactly. Industrial usage dropped. So the factories were actually using less power last year, which probably points to some economic softening.
So if the factories use less, how do they make more money?
Rate cases.
Ah, the price tag just went up.
Correct. They implemented new rates in North Carolina, South Carolina, Florida, and Indiana. This is that regulatory machinery at work. They got approval to charge more, so even if industrial volume dipped a bit, the overall revenue climbed.
Okay, so what about the gas side of the business?
Smaller, but very steady. Gas utilities and infrastructure brought in $559 million, also up. They had customer growth and, again, rate increases, specifically the Piedmont natural gas rate case in North Carolina.
It seems like rate case is the phrase of the day.
It's the lever that moves the world in utilities. But we have to talk about the other segment, because
Right.
this is where the ugly stuff sometimes hides.
Yeah, I saw other, and it was just a sea of red ink. An adjusted loss of almost $1 billion, $985 million. Why is this bucket losing so much money?
So this is the corporate holding level. It's where they park the interest on all that corporate debt we talked about. But there's a specific detail in the 2025 report that really grounds this in reality. Did you catch the note about the captive storm deductible?
I did. It explicitly mentioned Hurricane Helene.
And that is a stark reminder, isn't it? We can talk about AI and financial engineering all day, but at its core, this is a company that has assets sitting out in the wind and rain.
Right.
Hurricane Helene caused significant property losses. Duke has insurance, of course, but they have deductibles.
And those deductibles are in the hundreds of millions.
They add up fast, and that loss sits right there in the other segment. It reminds us that climate volatility isn't just a talking point for them. It is a direct hit to the balance sheet.
That makes the whole report feel a lot less abstract. It's not just numbers on a page. It's poles snapped in half by a hurricane.
Exactly.
So that was 2025. Let's look through the windshield. What are they telling us about 2026?
They're signaling confidence. They issued guidance for 2026 earnings to be somewhere between $6.55 and $6.80 per share.
So they expect to make even more money next year.
Yeah. They do. And they reaffirmed their long-term goal of 5% to 7% growth right through the year 2030. In fact, Harry Sideris, the CEO, said, "The fundamentals of our business have never been stronger."
He also said they expect to be in the top half of that growth range starting in 2028. That's a pretty bullish signal to the market.
It is. They're basically telling Wall Street, bear with us while we spend all this money, because in 2 years, the payoff is going to be significant.
But I keep coming back to this tension. I'm reading the release, and they have this whole section on affordability. They say they want to keep rates below the national average and keep any rate changes below inflation.
It is the eternal tug-of-war for a utility.
Like, can you really do both? I mean, you spend $103 billion, grow your earnings by 7% a year, A&E keep bills low. The math just feels tight.
Their argument is based on volume. Remember our AI discussion?
Yeah.
They believe that because the amount of electricity they're going to sell is going to skyrocket thanks to data centers, they can spread those huge costs over way more units.
So if Amazon buys 1 billion kilowatts, my share of the grid upkeep goes down.
Theoretically, yes. Volume solves a lot of problems. If you have massive new customers coming online, the unit price doesn't have to rise as fast as the total cost. That's the needle they're trying to thread.
Okay, so the plan is build big, sell to AI, keep the peace with the regulators. What could possibly go wrong?
Well, if you look at the risks and uncertainties section, a lot.
I love the fine print. Give me the nightmares.
We already touched on the AI bubble bursting, but there are 2 other big ones that stood out to me.
Okay.
First, regulation and environmental liabilities, specifically coal ash remediation and decommissioning nuclear facilities.
Those sound like incredibly expensive work.
They are. Cleaning up old coal ash ponds is a multi-billion-dollar headache. And taking apart a nuclear plant at the end of its life is unbelievably complex.
And the risk is what? Who pays for it?
Exactly. If the state regulators decide that Duke was negligent or just shouldn't pass those costs to customers, the shareholders take the hit. It is a massive liability just hanging over the books.
And what's the second nightmare?
They call it the death spiral.
Sorry, the what?
In the industry, yeah, it's the utility death spiral. The report lists self-generation as a competitive risk.
You mean like solar panels on my roof?
Solar panels, home batteries, the whole thing. Here's the problem. Duke builds the grid assuming everyone is paying into it. If you put solar on your roof, You buy less power from them. But Duke still has to maintain the wire to your house for when it rains or it's dark.
So my neighbor who doesn't have solar has to pay more to cover the maintenance that I'm not paying for.
Precisely. So their rates go up, which then makes more people want to get solar to escape the high rates, which drives rates up even further.
Hence the spiral.
The report explicitly mentions that private solar and battery storage could result in a reduced number of customers or create those stranded costs we talked about. It's a genuine existential threat to the whole monopoly model.
That really puts the $103 billion gamble into perspective. They are betting that the massive demand from AI and industry will grow faster than the residential customers can leave the grid.
That is the fundamental strategic bet of this 2026 report. They are pivoting toward big energy-heavy industry, data centers to anchor the business while trying to manage the transition for the individual homeowner.
It's a very high-stakes game. Okay, let's wrap this up. We've unpacked the numbers. 2025 was a solid year, hit the targets despite a messy Q4 and some hurricane damage.
A year of stability for sure.
And looking forward, they are pushing all their chips to the center of the table. $103 billion in CapEx, a massive bet on AI, a promise of 5 to 7% growth.
It is an aggressive, confident plan. They're trying to reshape the grid for a digital century.
But here's the thought I really want to leave you with. We talked about contracted demand.
Right.
We talked about how Duke is counting on these tech giants to pay the bills for this new infrastructure. But if that demand softens, if the AI revolution hits a speed bump, that infrastructure is still there. The concrete is poured, the wires are hung. And in a regulated monopoly, costs don't just disappear into thin air.
No, they get allocated.
Exactly. They get allocated to you. So when you see headlines about AI data centers, don't just think about chatbots. Think about your utility bill. Because in a very real way, we are all co-signers on this $103 billion loan.
That is a sobering way to put it.
Thanks for joining us on this deep dive into the Duke Energy 2025 report. We'll catch you on the next one.